thus far. There will inevitably, of course, be more of these papers from both the people, but this is a very significant day with Mark Carney, the Governor of the Bank of England, speaking here.
Okay, well, Lorna, thank you. I think that Mark Carney is just being introduced, so we'll listen in now.
With my team at the Banks Agency here in Scotland, our day job is to speak to businesses and organisations, many of whom are here today, and to pass that intelligence back to the policymakers at the bank. One of the aspects of the role that I particularly enjoy is the opportunity to bring those policymakers up to Scotland to come and speak to all of you directly. Today I'm delighted we have our Governor, Mark Carney, to address us. Mark became Governor last July, having previously been Governor at the Bank of Canada. Governor Carney has a wide-ranging experience across both the public and private sector. And I think like you, are very much looking forward to hearing his speech today. Governor.
Good. Thank you very much, Will. I'd like to thank SCDI, City of Edinburgh, all of you for your hospitality and make me so welcome. It's an absolute pleasure to be in Scotland today and to have an opportunity to hear directly from businesses about the economy here, because it provides insights not just to the economy across the UK, but more broadly across the globe. The recovery that began in Scotland is now taken hold in the United Kingdom, with the economy growing across the United Kingdom at its fastest rate since 2007. Now, a few quarters of above-trend growth driven by household spending represent a good start, but they're not sufficient. Even though unemployment is growing, even though employment is growing. Unemployment isn't growing, that's a good thing. And unemployment has fallen, particularly recently in Scotland, where it's well below the national average. The recovery has some way to run before it would be appropriate to even consider moving away from the emergency setting of monetary policy. The Monetary Policy Committee has noted that when the time eventually comes to increase interest rates, any such move would be gradual. And we hope that that helps reassure businesses here in Scotland and all around the UK that the path of interest rates will be consistent with achieving a sustained and balanced recovery in the face of the remaining headwinds that are stemming from the financial crisis. Now, Scotland, as you all know, is a land rich in history and ideas, but it's one to which I owe a great debt. Scots built the very foundation of my native land, Canada, provided the first Prime Minister of Canada, Sir John A. Macdonald, who was born in Glasgow. Scots have shaped the modern world through their contributions to culture and science, and the pioneering work of Scottish economists, from Adam Smith to my former supervisor, Sir James Mirrlees, have had a great influence on my profession. Among them is David Hume, who was born just a short walk from here, and although he's best known as a philosopher, he was a great friend and collaborator of Smith, and he wrote an essay of the balance of trade, which set out a theory of how trade imbalances between nations sharing a currency would self-correct as inflows of money to the surplus countries raise their prices and reduce their competitiveness. Now, Hume, of course, was an empiricist, and he would doubtless admit that the recent Eurozone experience of persistent current account deficits leading not to self-correction, but instead to crisis, requires a more elaborate explanation. And we're fortunate that over the years, economists have obliged with a substantial body of work on the economics of currency unions. And given the recent focus here on the currency, and given the fundamental role of the Bank of England in maintaining monetary and financial stability across the United Kingdom, I want to spend some time today drawing on that body of economics to review some of the most important issues with respect to monetary union. Now, I'm going to stick rigidly to what Thomas Carlyle described as the dismal science, and 20 minutes later you will know why he did so. Any arrangement to retain sterling in an independent Scotland would need to be negotiated between Westminster and Holyrood, and the Bank of England would simply implement whatever monetary arrangements were put in place. What follows is not an assessment of whether Scotland would be overall better or worse off under independence. That's a multifaceted judgment for the Scottish people. And it doesn't pass judgment on the relative merits of the different currency options for an independent Scotland, but instead draws attention to the key issues. This is a technical assessment of what makes an effective currency union between independent nations. So let me start by outlining the basic rationale for sharing a currency. And it was the economist Robert Mundell, a Canadian I might add, who first wrote about what determined an optimal or optimum currency area. And since then, others have elaborated and extended his work such that we now have a fairly comprehensive sense of the costs and benefits of sharing a currency. For Mundell, the main benefit was eliminating transaction costs associated with using and switching between currencies. And just by way of example, studies for the euro area put these transaction costs at about 0.5 percentage point of GDP. And that's, of course, an annual saving. Sharing a currency can also promote investment by reducing uncertainty about currency movements and giving businesses access to deeper, more liquid financial markets. It can reduce borrowing costs for countries with a history of high inflation and currency devaluations. And, of course, that was one of the motivations for many countries to join the ERM and ultimately the euro. Sharing a currency can also help promote integration by eliminating one of the barriers between markets and improving the transparency of pricing and increasing competition. And finally, sharing a currency can also help increase the mobility of labor and capital, raise the trade in goods and services, and improve the flow of technology and ideas. And in these ways, members of a currency union can exploit more fully comparative advantage and ensure greater dynamic efficiency, consistent with the objectives of a CDI. Now, set up against those benefits are some potentially large costs of giving up an independent monetary policy tailored to the needs of the region and giving up a flexible exchange rate that can help absorb shocks. A flexible exchange rate, in particular, acts as a valuable shock absorber when domestic wages and prices are sticky. For example, suppose demand for a country's exports falls. All else equal, its output will fall, unemployment will rise, and its current account will deteriorate. With an independent currency, an exchange rate depreciation can dampen these effects by improving competitiveness. And of course, at the same time, monetary policy can become more accommodative, supporting demand and employment. However, if a country were part of a currency area with that foreign market where the demand fell, its exchange rate would by definition not change, putting the full weight of adjustment on wages and unemployment, which is a significantly more protracted and painful process. In addition, the responsiveness of monetary policy to weak demand in that country would be diluted by the needs of the broader membership. Being in a currency union can amplify fiscal stress and increase both the risks and consequences of financial instability. So in the situation I just described, ideally fiscal policy would help smooth the adjustment to the external shock. But its ability to do so could be limited by the budgetary impact of the falls in output prices and wages. And to maintain credibility, fiscal policy may even become pro-cyclical, with the resulting austerity exacerbating the initial fall in demand. In the extreme, adverse fiscal dynamics could call into question the country's very membership of the currency union, creating the possibility of self-fulfilling runs on banks and sovereigns, absent central bank support. And of course, such feedback loops turned recessions into depressions in several European countries in recent years. So what makes a successful currency union with that backdrop? Well, the success of a currency area hinges on whether its features mitigate the costs of losing the flexibility that comes from an independent monetary policy. And these features generally promote alignment of economic cycles and the maintenance of price and financial stability within the Union. Now, the most obvious feature is similarity itself, similarity amongst members. The idea being similar economies won't suffer from a one-size-fits-all monetary policy. But somewhat surprisingly, a review of major currency areas suggests that similarity is neither necessary nor sufficient for success. For example, the industrial structures of the core and periphery of the euro area are more similar than those of the constituents of either Canada or the United States. Few would argue that the euro area is the most effective currency union of the three. Conversely, the Canadian monetary union works well despite having substantially larger industrial variation than the U.S. The similarity of the industrial structure of Scotland and the rest of the UK depends on how offshore oil is allocated. With oil split on a per capita basis, Scotland and the rest of the UK look about as similar as the core and the periphery of the euro area, i.e. quite highly similar. But with oil split on a geographic basis, they look about as diverse as the United States. Now, despite any differences, the facts are that the close integration of the Scottish and the rest of UK economies has helped ensure that their economic performance has been very similar over a long period, and output growth is highly correlated. So theory notwithstanding, being similar doesn't necessarily help, but being different doesn't necessarily hinder. That suggests we should look elsewhere for the ingredients of a successful union, to the mobility of labor, capital, and goods, to institutional structures that promote financial stability, and to institutions that mutualize risk and pool fiscal resources. So let me start with the first. The 5 tests formulated by the UK government to analyze the merits of joining the euro in 2003 were crafted in large part around the degree of integration between the UK and the euro area. And that's because greater openness and integration within a currency union not only enhances the benefits of a shared currency, but can mitigate the cost of losing exchange rate flexibility. Mundell and other economists originally argued that currency areas should coincide with regions which had high internal labor mobility. The idea being that by moving from areas where demand has fallen to areas where it has risen, workers would help moderate changes in wages and unemployment. Fairly straightforward. Now, in Europe, there are clear practical impediments to labor mobility, including language and culture. And as a consequence, Europe has a much lower cross-border mobility than the US, Canada, Australia, or the UK. And this has contributed to the need for painful internal devaluation in some countries in the Eurozone in order to restore competitiveness. So given that more than 700,000 Scots live in the rest of the UK, and over 500,000 from the rest of the UK live in Scotland, one would be tempted to assume that labor mobility between the two is high. In fact, gross migration flows between Scotland and the rest of the UK, while greater than the European countries, are much lower than the US, Australia, and Canada. And that probably, in part, reflects the fact that economic conditions in Scotland and the rest of the UK have been quite similar, very similar, such that the incentive for migration is relatively limited. It's reasonable to think that similarities between Scotland and the rest of the UK mean that there is potential for higher labor mobility should that become necessary. Given differences in industrial structure, this would put a premium on ensuring that barriers to labor mobility are not allowed to develop if monetary arrangements were to change. Now, it's not just an integrated labor market that helps adjustment within a currency union. Openness to trade and free movement of goods also assists in diluting the effects of shocks by spreading them across that union. And this helps to align economic cycles and make common monetary policy more appropriate. Here, Scotland and the rest of the UK are highly integrated. 70% of Scottish exports are destined for, and 74% of imports into Scotland come from the rest of the UK. However, there's a word of caution here. There is a wide body of evidence that national borders can influence trade flows, even between otherwise highly integrated economies. And the high degree of integration between Scotland and the rest of the UK may in part depend on their being part of the same sovereign nation. Mobility of capital can also promote necessary adjustments to shocks. Moreover, if capital in one part of the Union is owned by those in other parts of the Union, the effect of a shock is diluted across the Union. Simply put, risks and rewards are shared. Similarly, the ability to borrow from other parts of the currency union in deep and liquid cross-border capital markets or integrated banking systems allow one part to smooth out temporary falls in incomes. However, it has to be noted that free movements of capital can be a mixed blessing. If the funds provided by one part of the union to another can be withdrawn easily, these outflows can, if the right structures are not in place, undermine the economic and financial stability of all members. And that brings me to the second feature of a successful currency union, which is a banking union. Effective currency unions need a wide range of institutions to support an integrated and efficient banking sector. And these are often referred to as a banking union and include common supervisory standards, access to central bank liquidity and lender of last resort facilities, common resolution mechanisms, and finally, a credible deposit insurance schemes. Without a banking union, cross-border capital flows can be restricted, the effectiveness of monetary policy impaired, and in the extreme, the very viability of the union undermined. Now, it's as difficult to separate the institutions that support banking union from national fiscal arrangements as it is to separate the creditworthiness of banks from their sovereigns, and give me a moment to explain. In recent years, doubts about the resilience of major financial institutions have created expectations of sovereign support. The scale of those potential liabilities can in turn generate doubts about public finances, undermining the resilience of both banks and sovereigns. When such concerns emerge, the consequences can be dramatic. The banking systems of peripheral European countries experienced outflows of between 10 and 85% of total deposits from elsewhere in the Eurozone in the 3 years following June 2010. Bank funding spreads in those countries ballooned by more than 5 percentage points, and bank lending to the real economy collapsed, and credit conditions tightened massively. So clearly something needs to be done about these structural issues. It's in the interests of all countries, whether they're in a currency union or not, it's in the interests of all countries to sever the link between banks and sovereigns by ending too big to fail. And governments must put in place regimes that impose losses on banks' management, shareholders, and creditors rather than the taxpayer. And the Bank of England is at the forefront of efforts to establish common global requirements to do just that. And I will say that 2014 is the key year to complete the job here. Now, well, ending too big to fail, if we're successful in ending too big to fail, that should mean that taxpayers no longer have to bail out banks. It won't fully break down the bank sovereign loop for 3 reasons.